Hello everyone, welcome to Fundamental Analysis. My name is Varun Kapoor and I do appreciate you watching this channel. If you do like the content that you see today, then please do like this video and do subscribe, and I will make sure that I make more content going forward. Up today, a great name that I want you to discuss, it's called Experian, and I just wanted to discuss whether a great name like Experian is also a great investment. So let's jump in. So what does Experian do? So Experian is one of the largest data and information management companies in the world. If you ever go to any bank or if you go to any other financial institution and you want to take any sort of credit, car loan, house loan, then they are going to utilize Experian services to see how strong your credit history has been. And that essentially is a service that banks cannot do without, and therefore the products that Experian provides are mission critical products for companies that use the services. The company has two divisions. One is called business to business, the other one is called business to consumer. Business to consumer services are services that people like you and me can use to see how strong our credit history is and how strong our credit score is. And business to business is essentially used by large organizations and small organizations to see what kind of credit profile their customers, their suppliers currently have. In terms of revenue, it's a $5.5 billion US revenue. The company has $42 billion US market cap. It's got $3 billion US in debt, and that gives it an enterprise value of 45 billion US dollars. So what do I like about Experian? As I said in the beginning, I think it's a great company and there's a lot to like here. So just going through it very quickly, it's the largest data company in the world. The amount of data records that it has runs into hundreds and hundreds of millions, and it's very difficult, almost impossible for a new player to come up and build up a database which is comparable to the one that Experian has. In terms of its moat, it's very, very strong. There is a saying that you may have heard of. It's called "data is the new oil," and these guys have the data, and increasingly the demand for the data and the information that they have is growing across the world. The third point is recurring revenue nature. So the products that they provide are used on almost on a daily basis throughout the year and year after year by the clients. So from that perspective, it is revenue that comes into Experian's bank account every single month, which is a great characteristic to have as a value investor. The data that it has is mission critical. I think I already mentioned this, and a lot of financial institutions specifically, they can't really operate without the information that Experian provides. So from that perspective, the demand is going to continue to be very strong for them. The financial performance, which we will dig into in just a little while, is been very strong. It's been growing its top line. The EBITDA profitability has also been strong, and it's been generating strong cash flow. So we'll just mention that. And then finally, their business to consumer segment is been growing very, very strong, and they've been utilizing the information that it has and they've been slicing and dicing the information and creating new tools for customers like you and me to utilize their services, and that is going to put upward pressure on the performance of that particular segment. So really, there's a lot to like, and I think it's very difficult for anybody new to come in and replicate the services that they provide, and therefore their prospects look very bright into the future. In terms of the risks for this business, really, it's data management. Cyber attacks can affect them. Data management is regulated by governments now, and those regulations change. So that is another risk that we need to be careful and mindful of. But other than that, really, there is limited risks that this business has. So let's look at the historical financial performance of Experian. Here you can see revenue has gone from 4.3 billion in 2017 to 5.4 billion. Consistent growth at the top line level. EBITDA margin very strong, solid, and robust at 34%. And as you can see here, free cash flow available for equity holders has been around 700 million to 1.7 billion. And the fluctuation is really because of the acquisitions that they've been making. In some of the years, they have been repaying the debt, and that puts some pressure on free cash flow available for equity holders. But if you ignore the debt that they've been paying down, the overall performance, the overall cash flow generation has been very, very robust. So some valuation metrics here. You can see enterprise value of the business has gone from 21 billion in 2017 all the way to almost 46 billion right now, and that translates into an enterprise value to EBITDA metric, which was 14 times back in 2017, increasing to 25 times. And that is quite an interesting and important thing to keep in mind, because if you see the historical enterprise value to EBITDA was 14, 15 times, and then it increased to 20 times, and right now it's at 25 times. So you can argue that the valuation metrics for this group are elevated despite the strong credit and equity characteristics that this group has. Finally, in terms of leverage, the group has a policy of maintaining leverage at 2 to 2.5 times, and you can see here that they have been consistently in that range. So how do we project forward for Experian? Here you can see 5-year forward-looking information on Experian. The group is expected to grow quite strongly on an organic basis, and here you can see 12%, 10%, 12% growth for the next couple of years, which is consistent with the growth that the analyst community is expecting. And then after that, we're expecting a tapering down of the growth to 5% level. It is important to note that in the past, they have made around 4-5% organic growth year after year, but that has been including acquisitions. Here we're talking about organic growth only. So from that perspective, these assumptions in the outer years can definitely be considered to be on the aggressive end. EBITDA margin, 34% over the last 5 years. We have assumed that it stays around 34-35%, and it increases slightly in the outer years as the company becomes bigger and utilizes its information more efficiently. Free cash flow available for equity holders, average over the last 5 years. Mind you, this excludes the acquisitions that they have made, because we are really focused on the organic business case going forward, is around 62%. We have assumed that it stays around 60 to 65%, which is consistent with the historical financial performance. So what does it mean in terms of the valuation for this group? The free cash flow yield, which is a key financial metric that we look at, average for the last 5 years, as you can see here, is 3.9%. And assuming that the free cash flow yield stays at 3.9% at the time of exit, it gives me a valuation of $48 billion in 5 years' time. The other financial metric, the other valuation metric that we look at is called enterprise value to EBITDA. Now, as the business grows, EBITDA will grow, but the valuation is 25 times currently. We as conservative investors assume that it's going to go back to more reasonable levels, i.e. the levels that it has achieved on an average in the last 5 years, which is the 19.3 times that you can see here. And that gives me a valuation of 47.6 billion. So we've got two methodologies. One gives me a valuation of 48 billion. The other one gives me a valuation of 47.6 billion. Splitting the difference gives me a valuation of $47.8 billion in 5 years' time. So what does it mean in terms of the IRR analysis? As you can see here in this table, the current entry price, the current valuation of 42 billion, the company is going to generate free cash flow, which is 1.2 billion to 1.9 billion in front of us. And then the exit valuation that we calculated is 47.8 billion. and that gives me an IRR of 6.3%, which is quite a weak IRR. So I think it's a great company, and it's got a lot of positive characteristics that we as investors should like. I just think it's overpriced right now. The company's share price or company's valuation was around the $30 billion US mark sometime last year, and I think at those levels the IRR that you can expect to achieve would have been much better. So it's a name that I'm following very closely, and I'm a big fan of their services and their products that they're providing. But it's not in my portfolio right now because I think it's weak IRR that they're generating. And then finally, you can see in this table here, if the valuation goes from the 42 billion that is there right now to around 30 to 32 billion, then the IRR goes from 6.3% that we calculated to 10-12%, upwards of 12%, which will become quite attractive at that point of time. So this is a name I'm following quite closely. I think it's a great stock, but it's a great company, but the stock is overvalued. So I'm not adding this name to my portfolio right now. That was Experian. If you have any questions, then please reach out to me via YouTube, and I will make sure that I answer the questions as best as I can. Until we talk next time, thanks for watching. Bye now.